This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets. Crude oil prices are likely to rise above $100 per barrel due to strong global demand, market strategists said this week, citing a potential war between Russia and Ukraine as one of their top concerns for markets in 2022. Oil prices would gain if global supplies got disrupted, and as substitution, demand from skyrocketing natural gas prices in Europe and Asia picks up, along with reopenings from COVID-19 lockdowns, which will propel demand for aviation and other fuels, three strategists told the Reuters Global Markets Forum, GMF. The top geopolitical risk is Ukraine, said John Vale, chief global strategist at Nikko Asset Management in Tokyo. The trend looks good in general for commodities.
Tanker and barge shipments in and out of Europe's biggest oil hub have been delayed by up to a week as four storage companies scramble to resume operations after cyber attacks, sources familiar with the matter said. Since the end of last week, storage company oil tanking and oil trading firm Mabanaft, both owned by Germany's Marquardt and Bals, have been hit by hackers. Belgium's Seatank and Dutch fuel storage firm Evos have also been affected. The companies have had to suspend some operations, affecting oil flows in the Netherlands, Belgium and across Germany. It is not clear whether the cyber attacks are linked.
Moving on to the top news in the energy sector. U.S.
supplies of fuels such as diesel and heating oil have dwindled and refiners are having trouble replenishing that supply, which could keep prices elevated for months. Demand for distillates has been running ahead of pre-pandemic levels for months on strong manufacturing and trucking activity and more exports to Europe. However, production has not kept up as some refineries have closed since the coronavirus pandemic began while others put off maintenance. The situation has fed inflation for consumers and end users, and analysts say higher costs could persist as refiners find it harder to make enough products.
The price of permits in the European Union's carbon market closed at a record high above €96 on Friday, with analysts expecting the symbolic €100 level could soon be breached. Known as the EU Emissions Trading System, ETS, Europe's carbon market compels factories, power plants and airlines to pay for each ton of CO2 they emit. The higher the permit price, the greater the cost of producing planet-warming emissions, although some receive free permits to help them stay cost competitive in global markets. The carbon price has risen more than 200% since the start of 2021, due to factors including soaring gas prices that have also prompted some power generators to switch to coal, resulting in higher emissions and demand for permits.
Next, we have the top news in metal markets.
Steel demand growth in the European Union is expected to drop sharply this year as supply chain bottlenecks and soaring energy prices curb industrial operations, especially in the automotive sector, industry group Eurofer said on Friday. Apparent steel demand, which measures output of steel producers plus net imports minus net exports, is forecast to rise 3.2% in 2022 after an expected rebound of 13.8% last year. Demand growth is forecast at 1.7% in 2023. Ongoing supply chain disruptions, skyrocketing energy and carbon prices, as well as persisting inflation, are putting the recovery of the steel sector at risk, said Axel Eggert, Director General of the European Steel Association.
Copper and aluminium prices rose on Friday, supported by thin inventories, but worries that central bank rate hikes would curb growth and metal demand capped gains. 3-month copper on the London Metal Exchange, LME, had added 0.1% to $9,838 a ton by 1700 GMT, putting it on track to gain more than 3% this week. The U.S. economy created far more jobs than expected in January despite the disruption to consumer-facing businesses from a surge in COVID-19 cases, data showed. We will now look at the top news in the agricultural sector. China will allow imports of wheat and barley from all regions of Russia, the Russian state agricultural watchdog said on Friday, a new grain export success for Russia that could lead to greater competition for other suppliers like France. The move, announced as part of agreements signed during President Vladimir Putin's visit to Beijing, means China will no longer restrict trade in the cereals to certain parts of Russia, raising the prospect of Russia being able to send large vessels through the key Black Sea export route. Moscow has been attempting for years to expand cereal trade with China, and Swiss-based trader Solaris, a major exporter of Russian wheat, said in December it expected China soon to become a big buyer of Russian wheat.
That is all for today's news on commodity markets. Stay tuned to TradeFlow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.